And with that, we'd like to invite our next guest now. Live with us today on the market is Saurabh Mukherjea of Marcellus. Saurabh, thanks so much for joining us live today. I know you guys have your weekly meetings on Fridays where you come up with new ideas. Saurabh, you have always talked about staying with the compounders, long-term strategy, value stocks. This market is built for the current market construct is built for your strategy.
Yeah, looks very tasty. I can't complain about the correction. We were just discussing at the research meeting how much more money to put in. So we've invested heavily through the week gone by, and if clients' enthusiasm permitting, we'll carry on doing so. It's very rare in our career, right? All those who are watching included, it's very rare in our career that we'll get a 7-8 day period where you'll have India's largest cement manufacturer reporting 14% volume growth. The largest paint company reporting 19% volume growth, the largest private sector bank reporting 18% loan book growth, the second largest NBFC reporting 25% loan book growth, the largest IT services company reporting 15% dollar growth, so on and so forth. And alongside that, America reporting 6.5% GDP growth, and our country seeing the first privatization in 22 years, right? So it's one of those divine weeks where you got such a confluence of roaring economic growth, and alongside that, falling share prices, super tasty environment for loading up on great compounders.
You've always talked about, right, having the mindset of a test cricketer during a 2020 match. So you said you've bought a lot in the last 7-8 days. The same bunch of stocks that you talk about, in Asian Paints, Nestle, Titan, Pidilite.
Pretty much. So we carry on buying the market-leading franchises. You named some of them. We're also investing heavily in mid-cap. So we have a mid-cap strategy called Rising Giants. So in that strategy, we're investing heavily in, say, names like Astral Poly, Dr. Lal, Relaxo, Page Industries, Aavas Financiers, and so on. So what's delightful about this rally is across the piece, you're seeing high quality companies which are posting not just stellar volume growth, say double-digit volume growth. Many of these companies are growing free cash flows by 30-40% a year. And I'm including some big names such as, say, a Pidilite, such as, say, a Titan, where free cash flows are growing at a rapid rate. Obviously, in mid-cap names such as a Page, Relaxo, Dr. Lal, free cash flow growth is stellar, but that's to be expected even in larger companies. It's astonishing to see even in larger companies with $20-30 billion market cap, we're seeing free cash flow growth pushing towards 30%. So you're getting all of this good stuff. You got good visibility on growth over the next couple of years, and accompanied by falling share prices. It's like a test cricketer's dream, if you put it like that.
Right. Saurabh, we were just chatting with Samir Arora, and he said the one thing that the finance minister can do this time around in the budget is not do anything. So no negative news is going to be good news enough. And he said he's not anticipating any direct capital market announcements. What will make him do Bhangra post-budget day is obviously if LTCG is abolished altogether. But do you anticipate any direct capital market announcements from the budget this time?
Look, Samir is a wise man. He's also a senior of mine from school, so I can't disagree with him. I think he's right in saying that if the finance minister does nothing, that'll be a good outcome. I'm a little worried, though, I have to confess, I'm a little worried because there's a heavy-duty election calendar over the next couple of years. The government's fiscal wriggle room is limited, given that the disinvestment piece around BPCL, Concor, etc., hasn't quite fructified. The LIC IPO is in abeyance. So the disinvestment piece is critical. It hasn't quite fructified. The wriggle room is limited, and I'm a little jittery that could the government perhaps do something which impacts what optically looks like the interests of the rich in order to please the public. But I agree with Samir. I think my Bhangra skills are limited, but I think I'll also celebrate if the government does very little in this budget.
Which school is that, by the way?
I'm sorry, I couldn't quite catch that.
No, you said that Samir and you were both in the same school and he was your senior. I was wondering which school is that?
Well, this is a school called St. Columbus in Delhi. It boasts stellar people like Samir. I'm just lucky to attend that school.
Ah, of course. And Shah Rukh Khan. And many more. I didn't know you were a Delhiite as well. But okay, that conversation for some other day. Just wanted to understand then, we were just chatting also about this big meltdown, which is taking place in the entire new age tech, newly listed companies. And it seems like it's pretty much a synchronized move across the globe. I mean, why just the new age tech companies? Even the traditional IT plays seems like they're just blowing off the top. Are we getting into a long drawn phase of underperformance from IT where we may see some sporadic moves and re ratings, but you think the low hanging fruit and the good old days are now behind us?
I think there's two aspects to this. I think, as we've discussed on several of your shows over the last 3 months, when the first rate hike in an economic recovery happens, people naturally get jittery. It happened, as I've said before, happened in the 2004. The Fed started hiking in that recovery, and there was a little bit of a mini correction, and that's to be expected. And I think the current year, given that the Fed has pretty clearly outlined that they'll gradually hike through the current year, you're likely to see this jitteriness as speculators who have very little knowledge of fundamentals jump up and down vis-a-vis the Fed rate hikes. I'm not losing too much sleep about it because I've said this is par for the course. I've seen it again and again in my career. Towards the end of the first year of an economic recovery, the rate hikes begins and the speculator starts losing his nerve. But I think there's a bigger challenge, I think, for those who are investing in low quality tech names, right? Those who are investing in low quality tech names effectively were buying a story. The story was this company hasn't generated cash in the last 10 years, but due to some miracle of mankind, it will generate cash one day in the future. And I think gradually it's becoming clear to people, whether those investors are in America or those investors are in India, that a big chunk of these tech companies, consumer tech, fintech, a big chunk of them are simply economically unviable. And as a result, as the story kind of dissipates, as the story dissipates, the bubble gets pricked. And as you rightly said, the bubble's getting pricked in America, and similarly in India. I don't think that's got that much to do. The busting of the tech bubble isn't a Fed-driven thing. It's just the reality dawning on investors that a lot of these tech companies simply have no underlying economic viability.
Saurabh, your thesis is centered around buy compounders, champion franchise, they gain market share, and I think it was evident in the way HUL came out with the numbers. They've had market share gain in almost every category. While they may cry about rural demand, but they've gained market share and they've sustained margins. Do you think now it's time to start aligning to the other end of the spectrum, which is buy companies which would benefit as inflation comes down?
Right. So look, I think both the commodity cycle and the inflation cycle are not predictable things. A big chunk of the current burst of inflation, especially in the Western world, and a big chunk of the current WPI inflation in India is driven by supply side factors rather than by demand side factors. So for obvious example is this whole shortage of semiconductors, right? There's a supply side issue rather than a demand side issue. And because inflation and therefore commodity cycles are driven by supply side issues, it's very difficult for us to second guess when will inflation go up, when will it come down. What we try to do is to say that, look, if you take a 20-30 year span of data, oil prices seldom stay at $90, $100 consistently. Oil prices more likely tend to be in that range between, say, $30 to $60. And therefore, just to take an example, a company which uses oil or oil derivatives in its inputs, Pidilite and Asian Paints, etc., their margins will normalize when oil prices normalize. Now, when will oil prices normalize? None of us quite know, but we know that commodity prices seldom move up in a straight line. Commodity prices oscillate, and therefore input cost pressures oscillate. The critical variable for us to keep our eye on is volume growth and market share. If we are investing in companies which are consistently gaining volume growth or market share, be that a lender like HDFC Bank, whose volume growth in the last 3 years has been spectacular, actually. No private sector bank has remotely matched HDFC Bank in how they have gained market share in the last 3 years. Or say a paint company like Asian Paint, which has picked up 5% market share just in the last six quarters alone. If you can keep going, if you invest in companies which keep gaining market share whilst generating free cash flow, that's a tremendous outcome, and we will make a lot of money from that. So we try to look through the noise of commodity prices and inflation and focus on the underlying signal, which is the strength of the franchise.
So I'm going to keep financials aside because that's where the size of opportunity is very large. But for other companies, let's say a Titan or an Asian Paints or an Pidilite, when do you think the law of big numbers would kick in? These are companies which are growing at a phenomenal rate, but somewhere the law of numbers would kick in, the base effect would kick in for some of these companies, and when that would kick in, markets would say, can we give them these P multiples?
So I think one of the things which is still misunderstood, Nikunj, is the sheer scale of India, right? So just to put it in context, Titan's free cash flows have compounded at 30% in the last 20 years. Yeah, Titan's free cash flows have compounded at 30% for the last 20 years, which means in the last 20 years, Titan has grown free cash flows 200x, right? 200 times. But even today, a Tanishq's market share of the Indian jewelry market is 6-7%, which means there's a colossal runway for Tanishq ahead. Now, because of the sheer scale of India, we think, this company's done well for 20 years, must be maxed out. If you look at the market share numbers of Tanishq or an HDFC Bank, Tanishq at 6% and HDFC Bank at 10% loan market share in India, I would say, this is just the beginning of the story. Abhi to party shuru hui hai. Agla 20 years is the real runway as these companies go through and build, 100, 200, $300 billion market caps. So there's a lot of limited thinking in India, which misunderstands the scale of India and the scale of opportunity available to companies such as, say, a Titan/Tanishq or an HDFC Bank for that matter.
Okay, Saurabh, unfortunately, we've run out of time. It's been great having you. Like we said at the top of the interview, right? The construct of the market, it's made for the strategy that you folks at Marcellus follow. And thanks for being candid and telling us that you bought a lot in the last 7 to 8 days, and including those names from the broader universe.